All right, guys, so here we are now jumping into financial statements of chapter one, which is the introduction to managerial accounting. All right, so we're going to look at the financial statements of a manufacturing business. All right, so what are the four financial statements? All right, what are those? So come on, guys, make me proud. I know you guys learned this. So hopefully you came up with this same list. The balance sheet, the income statement, retained earnings, and the statement of cash flow. All right, so we are not going to focus on a statement of retained earnings, nor will we focus on the statement of cash flow, because it's very similar to that of a service business, right? So we're not gonna give our time to that. Where we will focus our time over the next maybe few slides or videos is on the balance sheet and the income statement, okay? Because these are a little more complex for a manufacturing business, because they instead of buying their product, they make their product, and we need to account for it a little bit different, okay? So let's look at how we must record and report the product costs for a manufacturing business, okay? All right, so let's look at first the balance sheet. So maybe to put things in perspective, think of maybe a manufacturing company versus a merchandising company, right? So a merchandising company could be a Sprouts or a Target or Gap, or not Gap, Walgreens or something like that. Those are all considered a merchandising business. They do not make their product, they just go and buy wholesales, or they buy pallets and pallets of product, and then they sell it on maybe to businesses to business or business to consumers. And then now you think or consider that of a manufacturing business. And a manufacturing business could be considered, you know, Fender as a guitar maker, or you have Ford, Tesla. All of those are considered manufacturing businesses, right? And so in that, they have to buy raw materials and then convert all of those raw materials into finished goods. So as you can tell, the process of them buying product is a little bit different, right? There's different categories, okay? So a manufacturing business, under a manufacturing business, there's three types of inventory. So before I go there, when we're talking about a merchandising business, such as a Sprouts or Target or Amazon, right? Walmart, another good example. They only have inventory, right? They buy it from the wholesaler and then they store it in their warehouse or what have you. All right, so put that in perspective. Now moving on, under a manufacturing business reports three types of inventory. They have materials inventory, work in process inventory, and also finished goods inventory. So let's take a deep a dive into each of them. So your materials inventory is considered your raw materials inventory, another word for it. It could be both indirect or direct materials, and these are raw materials that have not entered the manufacturing process yet. So maybe you went out to the your supplier maybe and bought these particular products, and they are literally maybe wood or screws or what have you, right? That would be considered raw materials, whether they're indirect or direct. Next, we have our work in process inventory. And what I'll read the definition for a second. Work in process just means, hey, I've started it. I've started the manufacturing process, but I haven't quite finished it, right? So remember, when we're doing financial reporting, we're doing it from the perspective of maybe a month time frame, right? So from maybe a January 1st to January 31st. And so maybe I started this process January 1st, but, you know, and I've manufactured a lot of product. And so as of January 31st, I am going to have some product that is still a work in process. They're not completely done. So it's direct materials, direct labor, and factory overhead costs for product that have entered the manufacturing process, but they're not done. They need a little more work, right? And then our last but not least one we have is finished goods. And finished goods is exactly what it sounds like. They're done. You finished all of the processing to it. You've added all of the direct materials, all of the labor, and all of the factory overhead to generate the final product. So it's completed or finished product that have not been sold. So right now it's just sitting there as inventory, finished inventory, right? So this is a good comparison between the two types of businesses. The very top one represents a merchandising business. And a merchandising business, as we mentioned before, like a Sprouts, Amazon, Target, right? They only would have inventory, and that's how it's listed on their balance sheet. Now, when we're talking about Legend Guitars or Tesla or Apple, again, they have the three different types of inventory as listed here. You have direct materials, work in process, and finished goods. If you're adding all of those together, that will give you your total inventory. Okay, so hopefully that made sense to you guys. All right, so now we're going to take a look into the income statement. And I find that this one is the most challenging because we have to consider some new terminology that we haven't before, right? And a whole new statement. So first, let's get into what we are most familiar with from Accounting 1A, which is the income statement of a merchandising business. Now, remember, a merchandising business is, as I mentioned, like a Target, right? So for Target or something of that nature, they'll have their sales, and then they have their beginning inventory and all of the purchases that they made. And so that is the inventory available for sale, less the inventory that they did not sell, and that equals their cost of goods sold. Now, just as a trip down memory lane, remember the purpose of the income statement is to match your revenue. So I feel like I need to write this. The purpose of the income statement is to match your revenues with your expenses. If you guys can remember that part, right? So if I sold, let's not say dollar value, but if I sold 1,000 shirts, right? Then I need to have my matching expenses that reflect the cost of those 1,000 shirts as well, right? So maybe for me, my revenue for selling those 1,000 shirts was, say, I don't know, you sold them at a dollar each. Let's say that was $1,000. Now the cost of because maybe you have buying power and things of that nature, the expense or the cost associated with selling those 1,000 shirts was maybe $400 because you bought it wholesale, right? So therefore, your gross profit or what have you would be $600. Okay. So just remember, think in those terms. The income statement tries to match all of your revenues and your expenses together. And that's what this, even though it's in a weird format, your cost of goods sold, you're just trying to figure out what that cost of goods sold number is. You're trying to make sure it matches with the items that you sold. And the difference will give you gross profit. Now, again, manufacturing business, a whole nother story, because it's different in the sense that you are not going to a wholesaler to buy the product, right? You're making this from scratch, right? You're buying the raw materials, and you have labor and you have machinery, and you're putting it all in like a big blender till you get your final product, which means you have to account for this a little bit different, right? And so under a manufacturing business, yes, you still have sales. Yes, you still have finished goods inventory, which you did not sell from a prior period. But now we have this new title called the cost of goods manufactured. Now, just for a second, read through that name very slowly so you understand it. It is the cost of goods manufactured, the cost associated with making all of the goods that we made in that period. That's all the cost of goods manufactured is, okay? The cost of making the goods that we made in that period. All right, so that amount will give you the cost of finished goods, and then you're going to subtract out what you did not sell to come up with your cost of goods sold. Now, just as a FYI, when you see this line, that means to sum up the two numbers here, right? And when you see this again, this means to sum up these two numbers, right? And when you see it come this way, that just means the sum of those two numbers. So we'll get into that, but I want to make sure I touch base with that. All right, so on the income statement, a manufacturing business makes the product based, how do a manufacturing business make the product they're selling? They need some direct materials, they need direct labor costs, and they need factory overhead. All three of those things added together, 1, 2, and 3, are considered your cost of goods sold, right? And so you have all of this other information, which is part of a formula, but I'm gonna walk you through what does that look like, okay? So for a second, before I end this video, let's just talk through the cost of goods manufactured. In order for us to generate an income statement, we must first generate the statement of cost of goods manufactured. Okay, so to determine the cost of goods sold, we must do the cost of goods manufactured. Okay, so we need to do this statement first, and then, right, if we go back here, if I can highlight for a second to you, right, we need to come up with this number first before we can even come up with our cost of goods sold, right? So this is a step that is mandatory. So as you work through the next example, just try to keep this template handy or easily accessible, because this will very much help you get through the example and make everything make sense, okay? So with that, I'm gonna stop, and then in the next video, I'm gonna pick up here, and we're gonna talk about the cost of goods manufacturing in the process to get to our